Okay, let's start with the second part. Welcome back, everyone. I hope you managed to get a little bit of a leg stretch and break. We're going to start with the second part of this conversation. And first up, we have Professor Brodjonegoro from the University of Indonesia. Welcome. We're looking forward to hear your reflections on the topics that we have been discussing in the first panel about the economy and finance in this new Anthropocene era, and also ahead of Stock Plus 50. So, Professor, thank you for joining us and welcome. The stage is yours.
Okay, thank you very much, Victor. Distinguished panelists, participants, ladies and gentlemen. First of all, on behalf of the Think 20 or T20 Indonesia, I would like to thank for the opportunity to be part of this Stockholm Plus 50 conversation. So this year, for us, for everybody actually, will be a crucial year in terms of recovery. Hopefully, of course, from pandemic, and also we can start mitigating the climate change. Indonesia will host the G20 this year. I mean, we already hosting the G20 this year, and also chosen as the chair of ASEAN, Association of Southeast Asia Nation, next year, giving the ASEAN region as a whole the chance to push topics that will help the global economic recovery continue toward a more fair global financial system and net zero economic transition to advance sustainable development. Despite our significant commitment to address climate change, ASEAN and its member states, and let me tell you why we use ASEAN, not only Indonesia, because altogether ASEAN is the fourth biggest economy in Asia after China, India, Japan. I mean, China, Japan, India, and ASEAN, even altogether above South Korea. So despite our commitment to address climate change, the ASEAN members are among, unfortunately, the fastest growing in the world, caused by, fastest growing emission in the world, caused by population growth, rising income levels, and subsequent development gains. Deforestation, peatland degradation, and agriculture activities such as rice farming all contribute significantly to agriculture, forestry, and other land use, or we used to call EVOLU, emissions in the ASEAN area. The region's forests have shifted from being a net sink to a source of emission during the last 2 decades, releasing over 500 million tons of CO2 every year, CO2 equivalent every year. The risk of postponing action on climate change far outweigh any imagined benefits. Climate change-related economic losses might be 60% more than originally projected, lowering our GDP by 11% in 2100, or as much as 37.4%. Meeting the Paris Agreement objective of stabilizing global temperature at far below 2 degrees centigrade, on the other hand, will only have 0.8% negative impact on the region's GDP. So, ASEAN has a unique window of opportunity to build on its commitment to sustainable development by transforming its socio-economic model into one that focuses on social, environmental, and economic sustainability as domestic and international financing increasingly shifts toward sustainable and low-carbon modes of economic development. There has been significant progress on disclosing the risks that climate change poses for financial return. A growing number of central banks, including our central bank, represented by Pak Reza here, financial institutions, and also investors are attempting to better understand and emphasize the economic and financial impact of climate-related financial risks. For example, we already launched the roadmap to sustainable finance by our Financial Services Authority of Indonesia. However, achieving sustainable development will not happen without a significant international support. Developed nations should take the lead in decreasing emissions and providing funding, technology, and capacity development to developing nations to aid in climate mitigation and adaptation. COP21 in Glasgow result also urged developed nations to increase their financial contribution with specific plan in place to meet $100 billion climate financial contribution per year. Apart from international contribution, private capital should be leveraged for green investment. Mainstream private funding is especially important in assisting businesses to realign their business model to achieve net zero emissions. Local initiatives such as marine protected areas should also be encouraged, as it may lead to improvement in economic equality, equality in access and governance, as well as providing health and environmental benefits to improve quality of life. I think that will be my introductory remarks, and of course, we'll be happy to discuss more at the Q&A session. Back to you, Victor. Thank you very much.
Excellent. Thank you so much, Professor. I would like to invite Dr. P.S. Angli Kusumo, just directly, just to continue this conversation about Indonesia and the regions from Bank of Indonesia. So if you would like to take the next. Thank you.
Novi, you kindly, okay. Pak Bambang, izin Pak.
Yeah.
Okay, thank you, Victor. Hello, everyone. I'm honored and delighted to be here. Good morning, good afternoon, or good evening to you all. I've been asked to provide my initial reflections in the context of Indonesia G20 presidency, which I will approach from the perspective of sustainable finance, hence the title of my presentation today. In the interest of time, let me start. In the last decade, increasing awareness of the Anthropocene risks has led to systematic changes in the world of finance. One notable instance is the increasing preference in the global capital markets towards sustainable finance. Sustainable finance can be broadly defined as the incorporation of risks and opportunities pertaining to the environment, social and governance, or ESG issues into business and financial valuation. A key driver behind this so-called ESG integration in finance is the changing stakeholders' expectations, particularly those of the consumers and investors. For the investors, the growing activism of global consumers with regards to ESG issues has altered the materiality of risk and return on finance on investment in a business, a company, or a project. Investors will go the extra miles in assessing the financial materiality of ESG issues so as to avoid having to deal with stranded assets in the long run. So ESG integrations into business and finance seems to be the rising norm nowadays. Several important trends with regards to ESG integrations are worth mentioning. First is the sizable increase in capital mobilization. A notable instance is the recent pledge by financial institutions under the Glasgow Financial Alliance for Net Zero during the COP26 in 21. The next step is to ensure the integrity of these pledges, particularly through the flow of financing to the developing economies. The second trend is the proliferation of ESG reporting and disclosure frameworks and the use of it. This trend is a welcome development. However, further work is needed to reduce the fragmentation of the existing frameworks. The third trend is the integration of ESG issues into private investing decisions, particularly among major investment firms and asset managers. For developing economies, this serves as an opportunity on the sell side. This opportunity can be fully exploited if domestic market for sustainable finance is developed and feasible climate-related projects and business opportunities for the buy side to consider are mobilized. The question now is, what can governments do to expedite capital reallocation for sustainable finance by private institutions? As a global common platform for advancing the market for sustainable finance, we already have the G20 Sustainable Finance Roadmap adopted in 2021 with 5 focus areas. The Indonesia presidency of G20 in 2022 is expected to continue the implementations of the roadmap around these 5 key areas. Given the trends and remaining challenges I've mentioned, Focus Area 1, Market Development for Faster Capital Reallocation, and Focus Area 2, Comparable Market Information are key areas which may yield strong reform benefits. In the near future, as mentioned by Rafael earlier, we expect the International Sustainability Standards Board to deliver a comprehensive global baseline of sustainability related disclosure standards for review and endorsement by international organizations of security commissions, or the IOSCO. If endorsed, the implementation of these key global public goods in various jurisdictions can be expected to lower the fragmentation of standards in the market and hence foster global capital reallocation through various channels. But more importantly, for developing economies, managing the transition to sustainable finance necessitates the development of the sell side. Governments in collaboration with international development institutions can play a role by ensuring the availability of steady streams of quality domestic ESG projects and business opportunities, and simultaneously developing transition-relevant financial instruments in the domestic financial markets, including market-based government sustainable financing instruments. These two must be diligently pursued in tandem to allow for the domestic financial institutions to smoothly adjust their portfolio and hence keeping the financial system stability intact during the transition. Accordingly, quality economic reforms to expedite the transitions of the real sector towards a green economy must also serve as a complementary part of the overall sustainable finance agenda, or the buy side of the market, to enhance the sell side of the market. The development finance institutions and multilateral development institutions are expected to play important roles to support the development of the sell side through actions in Focus Area 4 of the roadmap. Before I close, let me say a little bit about Indonesia. Through the implementations of Indonesia Climate Governance Framework, Indonesia will contribute to global joint efforts for a sustainable future, like Pak Bambang just mentioned earlier. In the area of sustainable finance intermediation, the Ministry of Finance, Bank Indonesia, and the Indonesia Financial Services Authority, the OJK, we have worked hand in hand in close coordination to gradually realign the domestic financial system and develop the market as well as policy instruments to support Indonesia's national contribution for the reductions of global GHG emissions. On that note, I will end here and return the screen to you, Victor. Thank you.
Thank you so much to both of you. I think I'm going to actually allow a couple of questions here from the audience. If you have something related to G20 or Indonesia, please raise your hand or add them to the chat, because I think I have one question to both of you maybe, and that relates to this roadmap, which looks quite ambitious. I'm curious to hear whether there's something in there about removing or having an overview of harmful subsidies, for example, for whether it's fisheries or fossil fuel extraction or deforestation, etc. Is that at all on the agenda on this roadmap? And where is it? Because to me, it sounds that it's not only about allocating more green capital. To me, it's also about removing some of the capital that is undermining resilience across many dimensions. I'd love to hear your reflections on that from both of you, if possible.
Okay, let me try to answer your question. I was finance minister from 2014 to 2016, and actually in almost at the end of 2014, that was the first time that Indonesia tried to remove totally the fuel subsidy. And at the time it works, and of course, as a result, the price increased. But at the time, as a government, what we are trying to do is to shift the subsidy from the commodity base into targeted subsidy or targeted social assistance, like many advanced countries had been doing until today. And it worked for the first years, 2014, 2015, but at the end, removing fuel subsidy is very much related to the political issue. I think you need to know that the so-called fuel subsidy has been there in Indonesia probably since late 1960s. So it has been there for more than 50 years. So you can imagine that people are still shocked, when suddenly there is no subsidy and the price becomes higher. And although the government trying very hard to shift the subsidy from the commodity base into the targeted subsidy, still this issue of the fuel price becomes a hot political debate. I believe it doesn't happen only in Indonesia. It happens, if I'm trying to follow the news all around the world, it happens in many developing countries that still needs some kind of subsidy in order to reduce the price. So this is the effort that Indonesia has been doing. And now, of course, we still adopt it to some extent, the subsidy, although the number has been relatively very small. But we still have another subsidy, for example, for electricity. And it's simply because the matter of price. And of course, the issue is most of our electricity still generated from the coal or gas, which is still considered as a fossil fuel. So I believe the agenda of the roadmap to sustainable finance will somehow include the removal of fuel subsidy, and probably the most important thing for Indonesia is to change the people mindset. Yes, we will give the subsidy, but instead of giving subsidy to fossil fuel, we need to give subsidy to the renewable energy. And in fact, the so-called subsidy or incentive for renewable energy is still very limited in Indonesia, unlike the subsidy for the fossil fuel. I think that will be my response to your question.
That's good. Thank you very much. Reza, do you have anything to add to that?
Okay, thank you, Victor. First of all, let me say this. We have observed significant changes in the consumer awareness of, we call it Anthropocene risks, or the bigger systemic risk facing our world today. But consumers have become more aware of the existential threats of climate change and how it will affect their daily life and even the future. So this increasing awareness has led to consumers demanding more accountability from producers of goods and services. And this has already affected the investment community, because then if consumers is asking for a better governance or better stewardship of the earth, then producers must adjust. Otherwise, this is what we call transition risk. Otherwise your asset will be stranded assets in the long run. So what investors are now demanding is that companies, start to investees. What I mean, companies that are investees, they have to start to take into account ESG issues, environment, not only environment, but environment and its interlinkages with social issues and governance issues. And when it comes to governance issues, this includes supply chain issues. You can have a product that you argue this is green, but if your supply chain, your suppliers are not green, then actually your product are not that green after all. So investors demand those ESG issues be incorporated in the investees' valuation. So this is a significant change, from a few years back. At least this is in the last decade. We see that increasingly the capital markets, big investors. I echo Rafael when he mentioned that asset management and big investment firms, leading global investment firms, they are all now putting ESG issues as part of their criteria for investment. And this is shown in the network, the Alliance for Climate Finance in the COP26 last year, where the pledges, if I'm not mistaken, is amounted to around 300 trillion US dollar in total. So, now the G20 through this sustainable finance roadmap is trying to ensure that there is a functioning market for capital reallocation, because the money is there and the intention is there. That's why I share the optimism of Rafael that perhaps this is, there are risks, but opportunities are also there, because transition risks involve transition opportunities. Businesses can create long-term value by responding more to their consumers, to the demand of the consumers and also regulators. The G20, through this sustainable finance roadmap, we would like to ensure that there is a functioning market for sustainable finance, for capital allocations, and also market information, useful market information for investment decisions. This is the focus area 1 and 2 that I mentioned earlier. What Rafael explained today is mostly on focus area 3, which is how policymakers, central banks and regulators mitigate the risk, not only the physical but also the transition risk, including this risk that more and more investors are beginning to value ESG projects more. And some big investment firms are also are already doing that. So we work towards that end, by putting everything together so that to ensure financial intermediation or what as I mentioned, capital reallocation can be aligned to this our aspiration for sustainable future. So it's part market solution, but also governments are doing a lot of reforms and try to implement this sustainable finance.
That's good. Thank you. Well, I think we lost your sound there, Reza, for a little bit. But I think we're going to we have one more question, I think, before we let our last speaker jump in. So Mary Ruckelhaus, you have your hand up. Please jump in. I'm not sure. I can't hear you properly, Mary. You are unmuted. I can hear, I can see, but can you give it a try?
Okay, how about this?
Yeah, that's a little better. If you can speak up.
Sorry, I'm moving to my phone. Is that better?
There you go. We can hear you. Thank you, Mary.
Sorry about that. Thank you to our Indonesian friends. I really appreciate this. I'm the director of the Natural Capital Project at Stanford. And our perspective is we work a lot with governments and development banks. And I'm very interested in what you have, what Raphael and Victor talked about earlier, is what are either the bright spots in the Indonesian government or the big challenges in integrating between the central bank vision and activities and the ministries that will be implementing this roadmap that you have. Are there bright spots of this kind of whole of government approach that we all see will be needed, or are there big barriers that you see? I'd love to hear your reflections on that. Thank you.
That's very good. So who would like to answer that? And a brief answer if possible, so we can move on to our last speaker, please.
Yeah, I think one of the biggest challenges in Indonesia in terms of switching our economy from carbon economy into a zero carbon economy is the investment, the appetite of investment in renewable energy. First of all, of course, because the price of renewable energy is quite high. And then the market in Indonesia, you need to compete. I mean, if you have renewable energy, unfortunately, you have to compete with coal and also with the gas, but mostly with coal in terms of electricity, and with the fuel for the transportation. So it means that we need kind of not subsidized investment, but investment with relatively competitive rates in order to make the investment in renewable energy will be as competitive as the fossil fuels. And then so far, the role of you mentioned about the MDBs, multilateral development banks, and also some development agencies from advanced countries is trying to do the blended financing, trying to bring the cost of money down for investment related to the effort to create net zero emission. I think that will be my short response, Victor.
Thank you very much. So we're going to, sorry, Dr. Zhang, for having you wait, but please, I mean, you have some prepared reflections as well that relates more to statistics and metrics that will be needed.
Right, thanks, Victor. It's a great pleasure to join the distinguished panelists today to share the experimental index work from our office and how these indices might help to assess social and environmental dimensions in finance. As mentioned by my fellow panelists just now, meeting environment, social, and governance ESG standards is gaining importance in the business and financial sectors. Now, 95% of SP global companies publish ESG information. However, there's a lack of a standard framework for defining material ESG factors. Then at UNDP, we have this Human Development Index that published 30 years ago. It's a simple composite index of 4 indicators covering 3 human development dimensions: health, education, and standard of living. Then this index has been utilized by agencies to evaluate social impacting a country. For example, the UN Principles of Responsible Investment list HDI, our Human Development Index, as one of the social indicators. Fitch Ratings also use HDI rankings to determine a country's human development, a quality of human capital. HSBC's Sovereign ESG model uses HDI as one of the 2 social sub-indicators. But compared to governance and social factors, environmental factors are given the least importance as observed in current methodologies. One of the many reasons being the difficulty in assessing the financial impact of environmental risk. So the first slide I'm showing you today introduces you the planetary pressures adjusted HDI experimental index published in our last Human Development Report. This PHDI, Adjusted Human Development Index for planetary pressures in the Anthropocene. It is computed as the product of HDI and adjustment factor A, shown on this slide. This adjustment factor is derived from a country's carbon dioxide emissions per capita and material footprint per capita. By adjusting a country's level of human development by its per capita CO2 emissions and material footprint, PHDI could serve as an important tool that will reflect each country's level of human development after adjusting for the planetary pressures it imposes. Next slide, please. Recently, we continued the experimentation and tried a new exercise to combine the PHDI and another index we developed in the office in 2010, Inequality Adjusted HDI, and constructed this called Planetary Pressures and Inequality Adjusted Human Development Index, PI-HDI. So Inequality Adjusted HDI was developed and published in the office since 2010, while the HDI can be viewed as index of the average achievements in human development dimensions. The Inequality HDI is the level of the human development when the distribution of populations is accounted for. So the new index, PI-HDI, is constructed as a product of IHDI and the planetary pressure adjustment factor A shown on the previous slide. So this PI-HDI can be interpreted as the level of human development when both inequalities in society and excessive pressures on the planet are accounted for. So this graph shows you the 144 countries, HDI, IHDI, PHDI, and PI-HDI values. But today's presentation is very brief, but I just want to show you some clear messages we can already see from the graph. We can see planetary pressures play relatively a larger role in discounting the HDI for countries with high development values, while inequalities are a bigger factor in discounting the HDI for low human development countries. Another clear message from this graph is that among the 54 countries in the very high HDI group, which we defined as the HDI values of 0.8 or higher, when you discount the HDI with inequality, 29 countries remain in this very high HDI group. But when planetary pressures are accounted for, only 10 countries remain in the very high HDI group. But when you look at PI-HDI, which means when we account for both inequality and planetary pressures, non-country maintain the very high level of human development. Next slide, please. Now let's look at HDI ranks, at PHDI, IHDI, and PI-HDI ranks. You also see only 5 countries from the top 10 HDI list managed to keep their top 10 spots according to PI-HDI. These 5 countries are Ireland, Switzerland, Germany, Sweden, and Denmark. But we also see some reordering here. There's a less variation at the lower end of the HDI rank. Next slide, please. As today's seminar is not only to stimulate discussion leading up to Stockholm +50 conference, but also in support of the Indonesia's G20 presidency. So I'm using the last slide as an opportunity to show the HDI, IHDI, PHDI, and PI-HDI values for the G20 countries. So here we don't have Saudi Arabia because we don't have the data to calculate its inequality HDI values. We look forward to having the opportunity to present our ongoing work on PHDI and PI-HDI at future Stockholm +50 workshops and the G20 meetings. Then I look forward to your comments and questions and more interactions during the Q&A session. Thanks, Victor.
Thank you so much, Dr. Sang. I mean, it's always interesting to see these metrics and the differences they make as soon as you start integrating more factors than just GDP. So any questions from the audience or other panelists to anyone who has presented in the second part of this conversation? You're welcome to raise your hand or put it on the chat. Yeah, Carl Folke. You're welcome. The stage is yours.
Thank you very much, Victor, and thanks a lot to really interesting insights from the presentations. I was trying to link it back to what Pat Keyes started with this afternoon on the need for new transformations of society, that we can't do business as before if we want to do this, and to what extent Reza and Rafael and several others of you feel that the adjustments we hear now from investors and capital markets are really that big transformation, or whether it's still more of following and readjusting on the current pathway. Basically, stop doing harm and start doing good. Are we seeing a new vision for the future? Are we seeing a new purpose emerging, or is it more adjusting to the demands that are becoming required because of the climate and the planetary crisis? What is your sense on that shift?
That's a very good question from Carl. Folke, would anyone like to try to give us some reflection on that? Anyone from the panel?
I may, please.
Yes, go ahead.
Okay, perhaps this relates to the increasing awareness. And we have seen that consumers are increasingly aware of these risks, and hence the demand side of the market are demanding changes, demanding more ESG or environmentally friendly products, and they want to make sure the supply chain of that product is governed with environment stewardship as well. So that is a big change. And now, as a result, investors start to see that unless the companies are incorporating these ESG issues, environmental issues, into their business models, then these companies will become stranded assets in the long run. So there is this pressure from the investors as well to these companies, to the producers, to start changing your behavior. Otherwise, I will not give money to you. I will not invest in you. And this is the growing trend nowadays. Big investment firms, big asset managers in the world are start doing that. They want ESG criteria be included in the financial report, reporting, accounting reports and disclosures. And that is why we are working towards more standardized reporting and disclosure frameworks. And the G20 is trying to provide that good public, that much needed global public goods, so that this capital reallocation can happen faster, can move faster. So I share the optimism of Rafael that but the starting point is increasing awareness of the consumers. So if we keep, educating consumers about the existential threats to the earth and then how those will affect their life, then I'm quite sure that moving forward, perhaps we will be in that area that, in the donut, the sweet spot, the donut that Pete, or from our colleague from Colorado, mentioned in the first presentation. So yes, I think the finance community is taking this seriously, and as seen in the G20 Sustainable Finance Roadmap.
Victor, I have a very good example following what Pak Reza just mentioned. I happen, aside from being a professor at University of Indonesia, I'm a non-executive director of basically mining and power company. And they used to work with coal coal mining as well as coal power plant. And then they realize that, the future is not there. And they are trying to switch to more renewable as well as environmental friendly activities. And then a couple months ago, they they signed kind of agreement with a company from other countries to set up electric motorcycle industry. And then after the announcement, the day after the announcement, the stock price of this company jumps very high. Usually it's relatively flat, but only on that day, because of that announcement, it jumps very high, meaning that the investor buying the idea that the sustainability or the ESG is the way of the future.
Interesting. Thank you so much. I think Karin Svensson from SIDA. Would you like to jump in here? Do you share this optimism? I think you work very closely with Swedish investors, but also the global investor network. And do you share this optimism? Is the finance sector really moving?
Yeah, thank you so much, Victor. And yes, I'm Karin Svensson from SIDA, and I work with global investors for sustainable development, that is UN convened with 30 of the world's largest institutional investors and a few companies, and also Swedish investors. And I can confirm, I also think there's a strong drive towards investing for the good and doing well by doing good, etc. But yeah, sometimes there's a little bit help needed, and we see in the GIS, and this is a question to the panel, actually, around the need for global political action to incentivize and penalize. So, GIST, they do all kinds of commitments, and they would like to put a price on externalities, for example, the company's emissions, to put a price on them. And many of them are arguing for a global carbon price, etc. And they are interested in investing in transition, but it's not so easy always to figure out the good economical model for this. So my question to the panel is, what are the needs and possibilities for global economic incentives and penalties around this to incentivize and to penalize? That's my question.
Good question. And also fits very nicely into the fact that this is contributing to Stockholm Plus 50. So what could happen and should be done during Stockholm Plus 50 related to this? Who would like to give it a shot to give some reflection?
Yeah, let me start just by saying that every country trying to now set their own agenda for phasing out, let's say, from fossil fuel and trying to be a net zero economy. Of course, every country has different timetable. For example, Indonesia now will try to declare that by 2060, yeah, still a long time to go, Indonesia will go into a net zero emission country, and coal will be phased out by 2056. Of course, it has been, communicated with some international agencies, including the MDBs, and one of our MDBs, Asian Development Bank, I believe has a very nice program as incentive to accelerate the retirement of coal power plant. They call it the program Energy Transition Mechanism. Basically, they will finance any country or any company that will try to retire their coal power plant much earlier. So, for example, if the coal power plant actually still has the contract, purchasing power agreement, let's say until 2040, then if they can retire in 2030, then there will be financing for ADB to that company in order to switch their coal power plant into renewable power plant, renewable energy power plant. I believe that's the type of incentive that now most of developing countries are looking for. How can they finance early retirement of coal power plant? Otherwise, they might better to wait until they feel that they are ready to be phasing out totally from the coal. Thank you.
Excellent. Thank you very much. Dear friends and colleagues, I think we have to wrap up. We're running out of time. This was a very, very rich conversation, and I think I'm going to let Pedro try to summarize this in a good way for us. Pedro.
Thank you, Victor. No, it was a joy and a delight, as I expected, to be able to participate and listen to the discussion. Let me just offer 3 reflections, not a summary as such, because I don't think it's possible to summarize the richness of the contributions and the discussion. First, I retain what Anne-Sophie said at the very beginning, that we may not know everything, but we don't need to know everything to act. We know enough to take many drastic measures, be it on the policy realm, be it in our individual lives, be it decisions by business, to change the trajectories that we are in. Secondly, Victor, you asked, so what is different today as we go to Stockholm plus 50 compared to 50 years ago, when Stockholm convened the first meeting in 1972? Well, I think the discussion today showed that many things are different. I don't think we would have seen central banks, Rafael, Pak Bambang, Reza, the interest, the attention that the financial and economic world is paying to these challenges, I think is quite new. We have very high expectations about G20 this year, so we're looking very closely to what the Indonesia presidency of the G20 will do. We will be supporting this effort, hopefully, as part of the collaboration also with the Stockholm Resilience Center and the Bayar Institute. Hopefully, Stockholm plus 50 is going to give an impetus to this change that is already happening. I was observing recently some data on capital expenditure by oil companies, because as you know, the price of oil dropped quite rapidly. It is now increasing, and one of the reasons why it's increasing is that many oil companies are not doing capital investments to the extent that they were doing in the past. So they are already reacting to all of these signals, even though we know that prices are not reflective of the challenges as they should be. But there's already a lot of change happening. So this is, I think, quite different compared to what was happening 50 years ago. But the final message is that the change is not happening quickly enough. And so that's why hopefully the G20 this year, Stockholm plus 15 are going to really give a push towards more fundamental change. Hopefully the work that we're doing on data, statistics, indicators will help the data that Jens presented. And I would conclude by saying that prices here are going to be key. That's how I started the seminar. Prices need to be aligned to reflect the real risks, not only of climate change, but the Anthropocene risks more broadly. But I think it's important also to emphasize purpose. I think that we need to highlight the importance of purpose. It's clear actually in the financial and investment world how important purpose is becoming in terms of people making investment decisions. But I think that purpose is something that, working along with prices and incentives, is a fundamental driver of change going forward. So thank you, everyone. Continuing the discussion, hopefully, and all of us have an obligation to put pressure to make change happen more quickly. Thank you. Bye.
Thank you, Pedro. Bye-bye, everyone. Thank you.
Thank you, Pedro. Thank you, Victor. Pak Bambang, izin.